When you look at a bank account and it says FDIC, did you ever wonder what that means? Or if you went to a credit union and it says NCUA, what is that? The FDIC is the Federal Deposit Insurance Corporation. It insures each depositor up to $250,000 per insured bank per account type. So what does that mean? So first off, what's insured? So the things that are insured are your checking accounts, negotiable orders of withdrawal, so those might be club accounts or like Christmas accounts or things like that. You have your savings accounts, money market deposits, CDs or certificate of deposits, and official items such as bank, cashier checks, money orders, things of that nature. What the FDIC does not cover are annuities, mutual funds, stocks, bonds, government securities, municipal securities, and U.S. Treasury securities such as T-bonds and T-bills, things like that. So the National Credit Union Administration, or the NCUA, also covers people at credit unions up to $250,000. The FDIC does not cover credit unions, so that's why you're not going to find FDIC at a credit union. So another question would be, what if you had more than $250,000? Can you have more than $250,000 at one insured bank and still be fully covered? Yes, there are ways to have more than $250,000 covered at one bank under FDIC, but you have to be in different account ownership categories. So Ally had a good way of explaining all of this, in that, say there are two people. They have single accounts that each are held at $250,000 coverage. If they have a joint account, each of them are covered to $250,000, so that brings up to about $500,000. In their retirement account, not the actual stocks that they're invested in, stocks won't be covered, but if they were CDs and other covered items in the retirement account, they could have coverage for that. And if they had a revocable trust, you could have CDs and high yield CDs and things like that, and each could be covered to $250,000. So this is just an example of a way for FDIC insurance to cover $2 million within a single bank. Personally, I would spread out my money through multiple banks, because if a bank does fail, it may be some time before you have access to those funds. When I open a bank account, what I'm looking for is it covered by FDIC? So here we have personal savings through American Express, and it has FDIC. If you go to Ally Bank, you'll see it down here, covered by FDIC, and HSBC, you'll also see that it has FDIC. Now, if you're really worried, what you want to go back is actually go to the Federal Deposit Insurance Corporation, and you can check whether or not something is FDIC, and you can check the banks through them. So if you wonder whether or not your bank is insured, you can look it up online, or here's the phone number. So if you ever wonder why the FDIC was started, it actually was started after the Great Depression and the stock market crash in 1929. So basically they were run on deposits at all the banks, and the banks didn't have enough cash in the bank to actually pay everybody out. So at that point, banks closed, people weren't able to get their money, and the federal government had to step in and come up with a way to protect people in the future from ever going through that same experience. So then in 1933, what happened is they had this Banking Act that came in through Congress, and they made the FDIC. I hope you found this to be informative. Remember, please subscribe, hit the bell. That way you'll know when new content comes out. And if you want to leave me a comment for any suggestions of new videos, please do so, and I'll research whatever you're asking for and make a video and let you know. Thanks for listening.